Southern California's coastline has long been promoted as one of the safest places to store real estate wealth, an almost untouchable paradise where property values were expected to rise, regardless of broader economic conditions. But behind the glossy image of luxury homes and sunlit beaches, a more serious shift is emerging, one that mainstream coverage often overlooks or downplays. This is not just a normal seasonal slowdown. It's a deeper disruption forming in some of the most desirable housing markets in the country. Inventory is climbing rapidly while buyer demand is cooling just as fast. As a result, many homeowners are stuck, unable to sell and increasingly strained by the cost of holding their properties. The long-held belief that home prices only go up is starting to weaken. Insurance companies are pulling back from the state, and higher interest rates are tightening affordability, creating conditions that could lead to a downturn similar in scale to 2008. In this analysis, we'll examine 10 coastal cities where homeownership has shifted from a dream investment into a growing financial burden. These are not minor markets. They are some of the most recognizable and expensive locations along the Pacific, now showing clear signs of stress. Pay close attention to the #1 city on the list. The level of financial pressure there may not only reflect a local collapse, but also signal broader risks for luxury housing markets nationwide. Before we begin, if you value clear, data-driven real estate insights, consider liking, subscribing, and sharing your thoughts on California's housing trends. Now, let's look at the evidence and identify which cities are weakening the fastest. Number 10 on the list is Oceanside. We're starting our analysis in the northernmost coastal city in San Diego County, an area that has historically thrived thanks to a consistent flow of military residents, along with spillover demand from more expensive neighboring cities like Carlsbad. That said, Oceanside is now starting to behave like a warning signal for the broader market. It's dealing with a growing backlog of unsold homes, a clear sign that the normal rhythm of buying and selling has begun to break down. When you dig into the numbers, from Redfin and local MLS data, the shift becomes impossible to ignore. Active listings in Oceanside have jumped more than 40% compared to last year, which is a dramatic spike. This kind of increase suggests that sellers are rushing to offload properties, while buyers have largely stepped away from the market. This isn't a typical seasonal slowdown. It points to a deeper imbalance between supply and demand, one that's creating an oversupply of homes that the market simply can't absorb right now. What makes the situation even more concerning is how aggressively sellers are adjusting their prices. According to Zillow, close to 30% of active listings in Oceanside have seen price cuts within just the past month. Many homeowners are reducing prices by tens of thousands of dollars, hoping to attract even minimal interest. Even with those reductions, properties are still sitting unsold. In many cases, single-family homes are staying on the market for over 60 days, which is roughly twice the typical time frame for this season. Affordability is a major factor here, especially with higher interest rates putting pressure on buyers. But beyond that, there are signs the local economy itself may be weakening. Data from the California Association of Realtors shows affordability in this area has fallen to its lowest level in 15 years, effectively pushing out the working-class buyers who have traditionally supported the market. At the same time, investors who jumped into short-term rentals during the pandemic surge are starting to feel the strain. Vacancy rates are climbing, and according to AirDNA, short-term rental income in the area has dropped by around 20%. That decline is forcing many heavily leveraged owners to list their properties all at once. From my perspective, Oceanside is exposing a critical weakness in the entry-level coastal market. When one of the most accessible beach cities becomes out of reach financially, and inventory begins to stack up, it creates a ripple effect, one that could eventually put pressure on the higher-priced markets further down the coast. Number 9 is Imperial Beach. As we move further down the coastline to the southwesternmost city in the continental United States, Imperial Beach stands out for a different reason. It's facing a combination of pressures that are pushing its housing market into decline faster than most areas nearby. While concerns about water quality and environmental issues do play a role, the bigger problem comes down to a sharp loss of buyer confidence. Over the past few years, prices were driven up aggressively by speculation, far beyond what local incomes could realistically support. Data from Realtor.com shows that the median listing price in Imperial Beach surged by more than 60% in just 3 years. That kind of growth wasn't grounded in economic fundamentals, and now the market is correcting, quickly and harshly. We're currently seeing a 55% jump in housing supply compared to last year. In a balanced market, you'd expect around 3 to 4 months of inventory, but Imperial Beach is nearing 8 months, which clearly signals a shift in favor of buyers. Even so, sales activity has slowed dramatically. According to CoreLogic, completed transactions are down 35% year over year. In simple terms, for every 10 homes that sold last year, only about 6 are closing now, leaving the rest sitting unsold and losing momentum. There are also growing signs of financial stress among homeowners. Mortgage data shows an uptick in default notices, with pre-foreclosure filings rising 18% in just the past quarter. This suggests that buyers who entered the market at peak prices are beginning to feel the strain. The rental market isn't providing much of a fallback either. Apartment list data indicates that rents in Imperial Beach have dipped by around 5%, which removes a key backup plan for owners who hope to rent out their properties if selling didn't work out. In my view, Imperial Beach highlights the risks of speculative hype. Investors rushed in, expecting rapid gentrification and rising values, but that momentum has now stalled. At this point, owning a property can cost nearly twice as much as renting in the same area. Without steady appreciation to justify that gap, holding on to real estate here is becoming a serious financial burden, one that many owners may not be able to sustain for much longer. Number 8 is Long Beach. Heading north into Los Angeles County, we arrive at a much larger market, one that's now straining under what can only be described as a full-blown condo crisis. Long Beach stands apart from many other coastal cities because of its heavy concentration of condominium developments. Right now, that segment of the market is unraveling at an alarming pace. The main pressure point comes from rapidly rising HOA fees and insurance costs, which together are pushing ownership out of reach for the average buyer. What once looked affordable on paper no longer makes financial sense once the full monthly burden is calculated. A closer look at local listings reveals just how extreme the increases have become. In some downtown buildings, HOA dues have jumped by more than 30% in a single year. These hikes are largely tied to stricter insurance requirements and long-delayed maintenance costs, expenses that new buyers are now being forced to absorb. As these carrying costs climb, many owners are scrambling to exit. The result is a market that's starting to resemble a liquidation phase rather than a stable environment. According to Redfin, condo inventory in Long Beach has surged by about 45% compared to last year. At the same time, units are taking much longer to sell. On average, condos are sitting for around 70 days, with some remaining listed for over 6 months without attracting serious offers. Prices are also beginning to slip. Recent market data shows that the median condo price has declined by roughly 4% year over year. For recent buyers, that drop translates into real financial loss, with some now owing more on their mortgages than their properties are worth. Adding to the pressure, the commercial sector in downtown Long Beach is struggling. Vacancy rates for office and retail spaces are near historic highs, which weakens the overall appeal of the area. When businesses shut down and buildings sit empty, the lifestyle that once drew residents in starts to fade. We've also seen a 22% rise in withdrawn listings this quarter. In many cases, sellers are pulling their properties off the market entirely because they can't secure a price that allows them to break even. From my perspective, Long Beach highlights a critical issue that many buyers underestimate: the hidden cost of ownership. It's not just about the mortgage. Once HOA fees and insurance are factored in, the total monthly expense can become overwhelming. What's unfolding here is a bottom-up breakdown, where entry-level condo inventory is piling up and losing value, signaling deeper instability across the market. Number 7 is San Clemente. Famous for its Spanish colonial-style homes and laid-back coastal vibe, San Clemente is now at the center of a noticeable slowdown in the luxury segment, one that's spreading across the southern edge of Orange County. This market depends heavily on affluent buyers and second home purchases, groups that tend to pull back quickly when economic uncertainty rises. And that's exactly what's happening right now. According to luxury housing reports from Coldwell Banker, sales of properties priced above $3 million in San Clemente have dropped by about 50% compared to the same time last year. In effect, high-end buyers have stepped away, leaving sellers holding premium properties with very little demand. The buildup of unsold homes is especially visible in the custom-built segment. Data shows that active listings for detached single-family homes have climbed roughly 38% year over year, adding to the growing inventory pressure. Another red flag is the widening gap between asking prices and final sale prices. Multiple listing service data indicates that homes are closing at around 94% of their original list price. That 6% difference can translate into hundreds of thousands of dollars in lost value, especially as sellers repeatedly lower prices just to attract offers. Even properties with ocean views, once considered the most desirable and easiest to sell, are now lingering on the market. The average time to sell a luxury home in San Clemente has stretched beyond 90 days, a significant shift from previous years. There's also clear evidence that buyer activity is drying up. Mortgage application data for this area shows a 25% decline in purchase applications, reinforcing the idea that demand has weakened considerably. Even cash buyers, who typically move quickly, are holding back and waiting for further price adjustments. From my standpoint, San Clemente is dealing with a serious liquidity issue. Many sellers aren't under immediate pressure to sell, so instead of lowering prices aggressively, they leave properties sitting on the market. The result is a buildup of stale listings that remain overpriced relative to current demand. If you're finding this breakdown helpful and want to see more data-driven insights like this, consider liking the video and subscribing to the channel for future deep dives. Number 6 is Hermosa Beach. Tucked between Manhattan Beach and Redondo Beach, Hermosa Beach has long been one of the most densely packed and expensive stretches of coastal real estate in the country. But that very density is starting to work against it, as today's buyers are prioritizing space and overall value, two things that are increasingly hard to justify here at current price levels. The market appears to have hit a ceiling, particularly when it comes to price per square foot. Recent sales data shows that this metric has already dropped about 7% from its peak earlier in the year, marking a noticeable reversal in a market once known for its consistency and exclusivity. At the same time, the number of unsold homes is climbing quickly. Inventory levels have surged, with active listings up roughly 42% compared to last year, according to local real estate board data. This increase is being fueled by a mix of investors exiting underperforming rental properties and longtime homeowners deciding to sell before values slip further. What's even more telling is how slowly homes are moving. In certain price tiers, the absorption rate has fallen to just 2.5 sales per month, which points to an almost complete slowdown in transaction activity. There's also been a sharp rise in listings that simply expire without selling. A review of MLS records shows that expired listings have doubled year over year, highlighting a growing gap between what sellers expect and what buyers are actually willing to pay. Financing trends are adding another layer of strain. Jumbo loan originations for purchases in Hermosa Beach have dropped by about 30%, suggesting that even high-income buyers are either unable or unwilling to commit at these price points. From my perspective, Hermosa Beach is going through a clear identity shift. Prices here were built around the assumption of a flawless market, but the current economic environment is anything but perfect. The premium buyers once paid for the lifestyle, proximity, prestige, and ocean access has started to fade. What's left is a market filled with properties that may still look valuable on paper, but in reality are becoming increasingly difficult to sell. At this stage, it feels like a standoff. Sellers are holding firm, buyers are stepping back, and the only way this tension resolves is through meaningful price adjustments. Number 5 is Huntington Beach. Often called Surf City, USA, Huntington Beach is now dealing with a surge of inventory that could erase years of steady home value gains. Because this is such a large and spread-out market, when conditions shift, the impact isn't subtle. It shows up quickly and on a wide scale. Right now, there are more than 500 active listings across the city, a total that has climbed roughly 35% compared to last year, based on Zillow data. This growing supply is colliding with weak buyer demand, especially as higher interest rates, hovering around 7%, push many would-be buyers out of the market. At the same time, many sellers are still anchored to outdated price expectations. The pressure is especially noticeable in the inland neighborhoods, where price reductions are becoming increasingly common. According to Redfin, about one-third of sellers in Huntington Beach have lowered their asking price within the past month. On average, those cuts are around $50,000, though some properties have seen reductions closer to $100,000 after sitting unsold for extended periods. There are also early signs of financial strain. Data from Adam shows a 12% increase in default notices, suggesting that more homeowners are beginning to feel the weight of current economic conditions. New construction is adding even more supply into an already crowded market. Projects that began during the boom are now being completed, but demand hasn't kept pace. As a result, builders are struggling to move inventory and are offering incentives like interest rate buydowns and credits toward closing costs just to attract buyers. Even with those incentives, new home inventory remains elevated, with roughly 9 months of supply, well above what would be considered a balanced market. In my view, Huntington Beach is a clear example of a suburban market losing momentum after a rapid run-up. With so many homes available, inventory builds quickly, and competition intensifies among sellers. The mindset has shifted. Homeowners who once believed they were holding on to highly appreciating assets are now realizing the peak has likely passed. Instead of setting the pace, they're reacting, lowering prices and competing directly with nearby listings for a shrinking pool of buyers. Number 4 is Dana Point. Known for its scenic harbor and striking coastal cliffs, Dana Point is now facing a tough market correction that many investors didn't see coming. What was expected to be a boost from the harbor's redevelopment has instead coincided with a noticeable slowdown in activity. At the heart of the issue is the rapid decline of the short-term rental market. Stricter local regulations combined with oversupply have significantly reduced profitability, and that shift is hitting this area especially hard. Many buyers originally purchased homes here specifically to operate them as vacation rentals. Now that those income streams are shrinking, a large number of owners are trying to sell at the same time. Data from AirDNA, along with local listing trends, shows that the number of furnished, move-in-ready properties hitting the market has increased by about 28%. These homes are typically listed at higher prices due to upgrades, but they're struggling to sell because traditional buyers aren't willing to pay extra for features tailored to investors. Overall, housing inventory in Dana Point has climbed roughly 36% compared to last year. At the same time, demand has slowed sharply. Based on current sales pace, it would take more than 10 months to clear existing listings, which firmly places the market in buyer-friendly territory. Financing trends reinforce this shift. Mortgage data indicates that loans for second homes in this area have dropped by around 40%, removing a key group of buyers that had been supporting prices for years. Homes are also taking much longer to sell. The median time on market has risen to about 85 days, a clear signal that liquidity has weakened and transactions are harder to close. From my perspective, Dana Point is a clear example of how regulatory changes and investor pullback can reshape a market. When property values are heavily tied to rental income potential and that income starts to disappear, prices inevitably come under pressure. What we're seeing now looks like the early stages of a broader sell-off, as investors begin to accept that conditions have changed and move quickly to exit their positions. Number 3 is Newport Beach. Widely recognized as one of the wealthiest coastal communities in the world, Newport Beach is now showing clear signs that even the most elite markets aren't immune to economic pressure. What's unfolding here is a slowdown concentrated at the very top end, where activity has nearly come to a standstill. We're focusing on properties priced above $5 million, a segment where transaction volume has dropped dramatically. Luxury market reports point to a roughly 60% decline in sales within the ultra-high-end category compared to last year. As a result, massive amounts of inventory are sitting idle, with little to no movement. The buildup of unsold luxury homes is becoming increasingly noticeable. Overall listings in Newport Beach have risen by about 30%, but when you isolate properties above $10 million, inventory has nearly doubled. Sellers, however, are holding firm on pricing, often resisting adjustments despite the lack of buyer activity. That resistance is leading to unusually long listing periods. Some properties have remained on the market for over a year without any meaningful price changes, creating what could be described as stale or inactive inventory that skews the broader picture of the market. When deals do close, though, the price cuts can be significant. Public sales records show transactions happening at discounts of 15% to 20% below original asking prices. In dollar terms, that can mean millions in lost value on a single sale, effectively erasing years of accumulated equity. Insurance is becoming another major obstacle. Coverage for high-value coastal properties has grown more expensive, and in some cases, insurers are stepping away from this segment altogether. That makes these homes harder to insure, and by extension, more difficult to finance. From my perspective, Newport Beach isn't collapsing so much as it is freezing. Wealthy homeowners aren't under pressure to sell, so instead, they're choosing to wait. But that lack of transactions creates its own problem. Without enough recent sales, it becomes increasingly difficult to determine accurate property values. If you have an opinion on what's happening in this high-end market, feel free to share your thoughts. Do you see prices eventually correcting? Or do you think this segment will remain stuck in a prolonged standstill? Number 2 is Santa Monica. As we move toward the top of the list, Santa Monica stands out as a city dealing with a two-sided problem: weakening commercial activity and a noticeable slowdown in its residential housing market. A key pressure point is the well-known 3rd Street Promenade, where several major retailers have shut down or left entirely. That loss of commercial energy is now spilling over into nearby residential areas, dragging sentiment and property values down with it. At the same time, office space in Santa Monica is struggling significantly. Vacancy rates have climbed above 25%, which reflects a major shift in the local economy, particularly the absence of high-earning tech workers who once helped sustain strong housing demand. That gap in demand is proving difficult to replace. On the residential side, inventory has risen sharply. According to Redfin, active listings in Santa Monica are up about 48% compared to last year, signaling a clear buildup of unsold homes across the city. The condo segment is feeling this pressure most directly. In several neighborhoods, prices have fallen by nearly 8% year over year, marking a noticeable correction in what was once considered a stable coastal market. Sellers are also adjusting more aggressively now. Around 35% of current listings have undergone price reductions, showing that many owners are struggling to attract buyers in a more cautious environment. In some areas closer to struggling commercial zones, homes are sitting on the market for extended periods, often exceeding 100 days. Buyers are increasingly selective, and many are choosing to redirect their attention to other cities they perceive as more stable. Policy changes are adding further strain. A new transfer tax on high-value properties has cooled the luxury segment significantly, with sales above $5 million reportedly down by around 70% since its introduction. From my perspective, Santa Monica's core fundamentals are under pressure. When the commercial center of a city weakens and concerns around livability rise, it becomes very difficult to sustain premium housing prices. The city's brand still carries weight, but that premium is clearly fading. And as conditions shift, the market is increasingly rewarding sellers who adapt quickly while penalizing those who hold on to outdated expectations. Number 1 is Malibu. We've reached the top of the list, and unsurprisingly, it's Malibu, arguably the most iconic beach city in the world, but also the one currently showing the most severe signs of stress. Unlike the other markets we've covered, Malibu's problem goes beyond interest rates or typical market cycles. What's unfolding here is an insurance crisis that is fundamentally reshaping the entire housing landscape. Major insurance companies have stopped issuing new policies in this high fire risk area. For homeowners who still need coverage, the California Fair Plan, the insurer of last resort, is often the only option, and it comes with limited protection at extremely high costs. This shift has had a direct impact on demand. Many properties are now effectively unfinanceable for typical buyers who rely on mortgages, which has narrowed the market down to cash buyers only, and even they are negotiating aggressively for steep discounts. The numbers reflect a dramatic downturn. Sales volume in Malibu has fallen by more than 55% compared to last year, essentially freezing the transaction market. At the same time, inventory is rising quickly. Active listings are up around 65% as more owners try to exit the market before conditions worsen further. We're also seeing extreme pricing adjustments. Some listings have been reduced by millions of dollars. For example, one property reportedly cut its price by $3 million and still failed to attract a buyer. This highlights just how sharply demand has fallen and how cautious buyers have become toward these assets. While median sale prices can fluctuate, the overall trend in price per square foot is clearly downward. Adding to the pressure, tighter coastal regulations are making it more difficult and expensive to renovate or rebuild, which further reduces property appeal and long-term value. There's also growing evidence of what's known as shadow inventory, homes being marketed privately rather than listed publicly, as sellers try to avoid showing extended days on market that could damage perceived value. From my perspective, Malibu represents a perfect storm. Financing is constrained by insurance issues. The buyer pool is shrinking due to broader economic uncertainty, and many owners are now actively trying to reduce risk by exiting the market altogether. In simple terms, this isn't a situation building toward a crash. It's already underway. Looking across all 10 markets, the pattern is consistent. Rising inventory, falling sales volume, and increasing resistance from sellers who are still anchored to past prices. From entry-level coastal areas to ultra-luxury enclaves, the Southern California coast is no longer operating as the stable wealth engine it once was. Markets eventually correct, and when they do, reality tends to override expectations. If you found this breakdown useful, feel free to like, share, and subscribe for more data-driven real estate analysis. And leave a comment with your thoughts on which city you think will see the sharpest declines over the next year.